Good day, everyone. So we are now at chapter 8, which is all about inventory management. This chapter begins with a brief look at various classifications of inventory, followed by a discussion of inventory costs. Next, we examine when to order inventory and how much inventory to order. This chapter also looks at inventory flows and special concerns with inventory and concludes by discussing several contemporary issues with managing inventory. Inventory. Inventory is a stock of goods or materials. So when we talk about inventory, we are referring to the stock of goods or materials that a business keeps on hand in order to meet customer demand. Inventory also serves as a cushion for supply-demand pattern. This means that having inventory can help a business handle fluctuations in supply and demand. Inventory management. Balancing inventory levels is challenging, and there are several reasons for it, including demand variability, supply chain disruptions, cost considerations, and many more. Also, conflicting objectives within and between organizations makes inventory management more challenging. Achieving the proper balance of inventory can be quite difficult also because of the trade-offs between inventory carrying costs and stock out cost. And now, let's take a look at the video for more information.
Hello everyone, welcome to today's video lesson on basic functions of inventory management. To begin with, inventory is one of the most important things for any business, and that's because the products help in generating revenue when sold. This means managing inventory is an essential activity for all companies. So what is inventory management? Simply put, regular counting, sorting, tracking, and storing of the products in a systematic way is called inventory management. Let us look at four main functions of inventory management. Number 1, to meet the forecasted demand of the products. For example, a properly managed inventory helps in handling high volumes of orders during the holiday season. Number 2, to safeguard against stockouts. For example, meeting high consumer demands during challenging times. Number 3, to facilitate production requirements. Counting stock regularly helps in forecasting how many more products need to be produced over a period of time. Number 4, to segment operations. Breaking down the manufacturing process into small tasks will improve efficiency and result in faster deliverables. In other words, when inventory management is done right, it serves all these functions effectively and enables you to order the right quantity at the right time. Are you facing any trouble in managing your inventory? Contact OrderHive now.
Inventory classifications. So, inventory classifications affects management approach. It is important to understand the various classifications of inventory because the classification can influence the way that inventory is managed. Inventory generally exists to satisfy demand and can be classified as cycle stock, safety stock, pipeline stock, and cyclic stock. So let's begin with the first classification, which is the cycle or base stock. This refers to inventory that is needed to satisfy normal demand during the course of an order cycle. So, for example, 1 dozen of eggs represents the cycle stock. We use 1 egg per day and we buy eggs every 12 days. Recall that Chapter 7 indicated that order cycle times continues to decrease in length, meaning that the associated levels of cycle stock continue to decrease as well. Second is the safety or buffer stock. Refers to inventory that is held in addition to cycle stock to guard against uncertainty in demand or lead time. For example, uncertainty in demand could come from the fact that you occasionally decide to make a 3-egg omelette as opposed to eating 1 egg per day. As an example of lead time uncertainty, you may sometimes buy eggs every 14 days rather than every 12 days. So in both cases, A few extra eggs would ensure that you won't run out of eggs. As pointed out in Chapter 7, higher levels of uncertainty lead to higher levels of safety stock. So the third is the pipeline or in-transit stock. Is inventory that is en route between various fixed facilities in a logistics system such as a plant, warehouse, or store. Pipeline inventory is represented here by eggs that are in transit between a chicken farm and, say, a food wholesaler's distribution center, or between the retail store and your kitchen. So the fourth one is the speculative stock. It refers to inventory that is held for several reasons, including seasonal demand, projected price increases, and potential shortages of product. So for example, the fact that eggs are associated with Easter, like for example Easter egg rolls, colored eggs, tends to cause an increase in demand for them prior to the Easter holiday. Although inventory generally exists to satisfy demand, in some situations, inventory is carried to stimulate demand, also known as psychic stock, the last classification of inventory. So this type of inventory is associated with retail stores, and the general idea is that customer purchases are stimulated by inventory that they can see. This concept helps explain in part why some retailers stock huge amount of certain merchandise. You might remember the basic accounting equation that assets are equal to liabilities plus stockholders' equity. Not only does inventory appear as an asset on company balance sheets, but inventory tends to be one of the largest assets in terms of dollar value on the balance sheets. As such, it is important for logisticians to have an understanding of inventory cost. A prominent concern involves the costs associated with holding inventory, which are referred to as inventory carrying or holding cost. In general, inventory carrying costs are expressed in percentage terms, and this percentage is multiplied by the inventory's value. An increase in cost percentage leads to risk, as this will affect relevant inventory expense. Many companies simply assign carrying cost as 25% of the value of their inventory, and this 25% figure has been used since the mid-1950s. So as you can see, the data shown in the table offer insights about the absolute and relative magnitude of inventory cost in the United States between 2010 and 2014. From an absolute perspective, the table indicates that the value of business inventory ranged between $2.1 trillion and $2.5 million between 2010 and 2014. In relative terms, inventory costs between 2010 and 2014 represent approximately one-third of total logistics cost. Components of inventory carrying cost. So there are 7 components of inventory carrying cost. First is the obsolescence cost. This refers to the fact that products lose value through time. Next is inventory shrinkage. Refers to the fact that more items are recorded entering than leaving warehousing or retailing facilities. Next is the storage cost. Refers to those costs associated with occupying space in a plant, storeroom, or warehousing facility. Next is handling costs. Involve the cost of employing staff to receive, store, retrieve, and move in inventory. Next is insurance costs, which insure inventory against fire, flood, theft, and other perils, are another component of inventory carrying costs. Next is taxes. They are calculated on the basis of the inventory on hand or on a particular date. And the last is interest costs. Take into account the money that is required to maintain the investment inventory. Ordering cost. Ordering costs refer to those costs associated with ordering inventory, such as order cost and setup cost. Order costs include, but are not limited to, the cost of receiving an order and conducting a credit check. Setup costs are those necessary to modify production processes to make the products to satisfy particular orders. Trade-off between carrying and ordering cost. The trade-off exists between carrying and ordering cost is that they respond in opposite ways to the number of orders or size of orders. That is, an increase in the number of orders leads to higher order cost and lower carrying cost. It is necessary to understand how to calculate ordering cost and carrying cost. Ordering costs can be calculated by multiplying the number of orders per year times the ordering cost per order. Because of the assumption of an even outward flow of goods, inventory carrying costs are applied to 1/2 of the order size, a figure that represents the average inventory. So we have here an example of how to compute ordering cost and carrying cost. Suppose weekly demand is 100 units, order cost per order is $80, the value of an item is $50, and carrying cost is 20% of the value of an item. If you place one order per year for the product, ordering cost is equal to number of orders per year times ordering cost per order. So that is OC is equal to 1 times $80 is equal to $80. For the carrying cost, it is equal to average inventory or 100 times 52 divided by 2 times carrying cost or the value of the product $50 times carrying cost of 20%, that is CC is equal to 2,600 times $10 is equal to $26,000. Alternatively, look what happens to ordering and carrying costs if we place one order per week. So, ordering cost is equal to 52 orders times $80 per order, that is equal to $4,160. For the carrying cost, average inventory 50 times carrying cost, which is the $10, that is equal to $500.